Classifications and elements of insurable risk insurance exam prep. Question 1. Which type of risk involves only the possibility of loss or no loss? Pure risk, standard risk, preferred risk, insurable interest. Pure risk presents no opportunity for financial gain, only loss, making it insurable. Question 2. Which type of risk involves the possibility of either loss or gain? Speculative risk, standard risk, uninsurable risk, catastrophic risk. Speculative risk, such as gambling or investing, involves a chance of gain and is generally uninsurable. Question 3. To be insurable, a loss must be clearly identifiable in time, place, and cause. What is this called? Random selection, definite loss, adverse selection, preferred risk. A definite loss ensures the insurer can verify that a covered event actually occurred. Question 4. An insurable loss must have a value that can be quantified in dollars. What is this called? Definite loss, adverse selection, measurable loss, standard risk. A measurable loss allows the insurer to determine the appropriate amount of indemnification. Question 5. What characteristic allows insurers to estimate future claims based on historical data? Definite loss, large loss exposure, predictable loss, insurable interest. Predictability enables insurers to use the law of large numbers to set accurate premiums. Question 6. To be insurable, a loss must be fortuitous and outside the insured's control. What is this? Homogeneous units, predictable loss, calculable premium, accidental loss. Insurance covers unforeseen accidents, not deliberate acts by the insured. Question 7. What type of risk affects a massive number of people simultaneously and is typically uninsurable? Insurable interest, uninsurable risk, catastrophic risk, standard risk. Massive, simultaneous losses, like war or nuclear events, can bankrupt insurers, making them uninsurable. Question 8. Insurers need a large number of similar risks to predict losses. What are these called? Calculable premium, homogeneous units, intentional loss, pure risk. Homogeneous units are exposures with similar risk profiles necessary for statistical accuracy. Question 9. The tendency of higher risk individuals to seek insurance more aggressively is called what? Independence of exposures, adverse selection, economic hardship, calculable premium. Adverse selection occurs when those most likely to have claims by insurance, skewing risk pools. Question 10. Insurers aim to prevent risk concentration through geographic dispersion. This relies on what concept? Homogeneous units, independence of exposures, substandard risk, random selection. Independence means a single peril shouldn't cause losses to a massive portion of the risk pool simultaneously. Question 11. What must be established to prove a financial loss would be suffered if the insured event occurs? Economic hardship, insurable interest, large loss exposure, calculable premium. Insurable interest is required to prevent insurance from being used for gambling or profiting from a loss. Question 12. What element ensures the loss is significant enough to warrant buying insurance? Pure risk, uninsurable risk, calculable premium, economic hardship. The potential loss must be severe enough to cause economic hardship, justifying the premium cost. Question 13. What allows an insurer to charge an appropriate price for the risk assumed? Accidental loss, standard risk, predictable loss, calculable premium. The insurer must be able to calculate a premium that covers claims, expenses, and profit. Question 14. What type of loss is deliberately caused by the insured and is strictly excluded? Intentional loss, standard risk, Economic hardship. Catastrophic risk. Intentional losses violate the accidental nature of insurable risk and are excluded. Question 15. What classification is given to an applicant who represents an average, acceptable level of risk? Calculable premium, large loss exposure, random selection, standard risk. Standard risks pay normal premium rates as they meet average underwriting criteria. Question 16. What classification applies to applicants with higher than average risk profiles? Insurable interest, substandard risk, speculative risk, uninsurable risk. Substandard risks are accepted but charged higher premiums or issued restricted policies. Question 17. What classification is given to applicants with lower than average risk profiles? Homogeneous units, pure risk, preferred risk, speculative risk. Preferred risks exhibit healthy lifestyles or safe habits and qualify for discounted premiums. Question 18. What is a risk that an insurance company will not cover under any circumstances? Homogeneous units, standard risk, predictable loss, uninsurable risk. Uninsurable risks fail to meet the required elements of insurability. Question 19. What principle ensures that the pool of insureds is diverse and not just comprised of high-risk individuals? Independence of exposures, random selection, adverse selection, standard risk. Random selection helps balance the risk pool with both good and bad risks. Question 20. What term describes a risk situation where the potential financial impact is substantial? Measurable loss, adverse selection, accidental loss, large loss exposure. Insurance is designed for large loss exposures that an individual cannot afford to retain.